Welcome to Cambridge Trust Wealth Management's first quarter market overview. My name is Jeffrey Smith. I'm Executive Vice President and Head of Wealth Management for Cambridge Trust. I will serve as today's moderator. I am joined today by four of my colleagues: Ryan Hanna, Senior Vice President, Deputy Chief Investment Officer, and Director of Equities, who will provide the market overview. Kelly Broderick, Senior Vice President and Chief Fiduciary Officer, who will share some estate planning techniques. Susan Mattori-Baker, President of Cambridge Trust New Hampshire, who will share some ideas around the advantages of New Hampshire trust laws. And Danielle Remus-Hackel, Senior Vice President and Chief Marketing Officer, who will share some news on the Eastern Bank merger. A couple of housekeeping items. Number one is this webinar will be recorded. And number two, if you have any questions, we'd ask you to use the Q&A button and we'll field those questions as time allows. Before I turn the program over to Ryan, I just want to emphasize two items. To our Cambridge Trust Wealth Management clients, I want to assure you all that there will be no changes. Let me repeat, no changes to the team that you're used to serving you. Your portfolio manager, relationship manager, and wealth advisor will all remain intact. And secondly, Danielle will take you through more details. The Cambridge Trust brand for wealth management and private banking will remain the brand for the combined entity. And we are super excited about joining with our Eastern Bank wealth management clients. So let me turn the program over to Ryan Hanna for a market overview. Ryan.
Thank you, Jeff. Thank you, everybody, for joining us this afternoon. Couple of prepared comments, a handful of slides to go through, and then I'll turn it over to my colleagues. A lot has transpired in the markets over the last few years in terms of the lingering effects of the global pandemic, shocks to our supply chains, and inflation that soared to more than 9%, all leading to one of the most aggressive Federal Reserve rate hike campaigns in decades. The period following the Great Financial Crisis was anything but normal, but it appears the market is settling into its new normal post the Great Financial Crisis and the pandemic. This new normal entails higher levels of interest rates, stickier inflation than we've been accustomed to, and the resumption of a more normal cadence to economic growth. Things are far from perfect, although it seems that every year there's a lot to worry about. We're about 200 days away from the next presidential election, yet our political system is as divided and dysfunctional as it's been in recent memory. We have a large and growing federal deficit, and our debt burden will be problematic over the long term unless we address spending and entitlements. Consumer spending is slowing, housing markets are feeling the impact of 7% mortgage rates, and stubborn pockets of inflation make it more difficult to put food on the table for the average family. On the flip side, the Federal Reserve appears to have done what most people thought was impossible: navigate a soft landing, bringing inflation down, keeping job growth strong and unemployment low, while maintaining positive economic growth. This was the Goldilocks scenario, and it appears to have played out. This has propelled the stock market to all-time highs, driven further by corporate earnings growth, profit margins that are inflecting higher due to moderating costs, and importantly, new and emerging technologies that are creating hope for a strong capital spending cycle, future productivity gains, and potentially a healthier population. Taking a step back, we must acknowledge the big picture and many of the major structural themes that are driving asset markets and how sustainable each of these themes may be. Things like artificial intelligence, cloud, GLP-1 drugs for the treatment of diabetes and obesity, onshoring, power generation, grid infrastructure, and much, much more. These trends make for a lot to be excited about. Today, I'm going to spend about 15 minutes reviewing different aspects of the investment landscape, including a bit on the stock market and trends driving stock prices, the bond market and current yield environment, Fed funds, and when we may see interest rate cuts, and a few charts on the broader economy. I'll finish with two themes that we're particularly positive on. On the first slide, this is a 5-year price performance chart of the S&P 500. Since December, actually November, which coincided with what we referred to as the Fed pivot. The Federal Reserve got much more constructive on a soft landing scenario and referenced upcoming rate cuts in 2024. Since December, the Federal Open Market Committee has increased expectations for real GDP growth in 2024, 2025, and 2026, while modestly raising its forecast for core PCE growth. Ultimately, growth will be stronger, inflation will be a little bit hotter, and employment will improve. And this has driven stock prices higher to all-time highs. On the next slide, earnings drive stock prices. That ultimately is what we believe. And over the last 20 years, as you can see in the box in the middle, earnings growth has been about 7.5% per year over the last 22 years. If you look at the far right side of this chart, in 2024 and 2025, we expect earnings to accelerate to 11% this year and 13% next year. If you layer on a 1.5% to 2% dividend, you're looking at low double-digit returns. And valuations, while stretched, may pull back some of that return. So we are expecting mid to upper single-digit returns for stock markets going forward in the S&P 500. On our next slide, a lot has been made of the Magnificent Seven. Magnificent Seven comprises 7 of the largest stocks in our economy. And last year, they represented almost 86% of all of the gains saw in the S&P 500. Most of those, actually all 7 of those stocks last year were up a factor of at least 2 to 10 times what the market was up. So all 7 of these big stocks, Apple was up 54%. That was the least of the 7. And NVIDIA was up 246% last year. That was almost 10 times what the market was up. This chart and what we're looking at here is 2024 performance. And what it shows, I know the squiggly lines can be a little bit hard to interpret, but what it shows is a little bit more dispersion in terms of the broader results. At the bottom, we have Tesla, which is down 31%, and Apple, which is down 12% year to date. And on the top, we have NVIDIA, which is up another 91% year to date. The point is, we have some stocks that are doing much better this year and other stocks that are underperforming. And market breadth is expanding. And we're starting to see more participation in the market this year than we did compared to last year. On the next slide, you can see a sector representation of some of the gains that we're seeing and how broad some of the participation is. Communication services and information technology still reside near the top, and we're seeing some of the best gains in those areas of the market. But then you have energy, financials, industrials, and materials, which could be construed as value-oriented sectors of the economy or old economy sectors, which are also doing quite well. The point being, we're seeing some healthy participation across different sectors of the market and more broad participation across markets. The next slide. In terms of valuations and what we're seeing for the S&P 500, the larger names, the names at the top of that market, the 10 largest stocks, do trade at a premium to the rest of the market. The light blue line shows just the top 10 stocks in the S&P 500 trading at a very healthy 25 times earnings. The rest of the market, the rest of the 490 stocks, traded about 19 times earnings. So while still elevated, much more in the range of what we've seen over the last 20 years. If you look at the next slide, we would argue that some of this relative valuation spread is justified. It's justified by higher sales growth. The chart on the left shows the Magnificent Seven in terms of revenue growth expectations between 2023 and 2026. Combined, we're looking for almost 12% revenue growth for the Magnificent Seven relative to 3% for the rest of the market. 4 times higher on a sales basis. And if you look at the right-hand chart, this comes at much better profitability. So generally speaking, the large 7 stocks, the Magnificent Seven, trade at much more profitable levels relative to the rest of the market. So with higher sales, higher earnings growth, better profitability, and what we view as fortress balance sheets with generally net cash on the balance sheet, we believe that some of this premium valuation is justified. Next slide. One question we get a lot from clients is this market looking a lot like 2000? The 1990s was a tech-driven market led by a lot of the tech-related names as the internet emerged. And as we look at the market today, it is similarly tech-driven, driven by artificial intelligence and some of the other major themes that we see happening out in the market. A couple of key differences that we think are very, very important. First is valuations. So if you look at PE ratios on the largest 20 stocks in 2000, the median PE was 42 times earnings. And if you look at the median earnings today for the largest 10 stocks in the market, they're trading at 26 times earnings. As I alluded to on the previous slide, we think that the profitability of these companies is much, much different today than the previous generation of large cap stocks back in 2000. So on the far right, I have circled the net profit margin for these top 10. This is a median figure of 11% back in 2000. And if you look individually, there's at least 5 companies that had net margins below 10%. Currently, the median net margin is 28%, and there's only one company, Amazon, which shows net margins below 10%. So while there are similarities to 2000 in terms of the tech-related leadership in markets, we believe the companies in today's top 10 represent higher quality companies with real earnings and real solid balance sheets to justify their rank in the markets. I'm going to pivot a little bit on the next slide to Fed funds and where we are in terms of Fed fund rates and what we expect for 2024 in terms of potential rate cuts. You can see we've gone from basically 0 to 5.38%. That's the range between 5.25 and 5.5. That's currently where the Federal Reserve sits in terms of Fed fund rates. The blue dotted line is their year-end estimate for the Federal Open Market Committee's expectation for rates at the end of this year. And you can see their estimate is for 4.6%, which would indicate somewhere around 3 rate hikes in 2024. The timing of those 3 rate cuts is uncertain. When we came into this year, there was an expectation there would be 6 rate cuts. But because the economy has done as well as it has, that expectation for rate cuts has come down from 6 to 3. And you can see the market, which is in green, is not all that different in terms of what that expectation is for rate cuts. So as it stands today, the market expects at least 3 rate cuts to happen in 2024 and potentially 3 more in 2025. The next slide. This is a chart going back 35 years of 10-year U.S. Treasury rates. And I've kind of put 3 different lines in here just to give you some context and perspective. The dark black line in the middle represents the 35-year average of the 10-year Treasury rate, which is 4.2%, which is basically right where we are today. So interest rates today are basically the average of where we've been over the last 35 years. If you look at the red line, this is post-Great Financial Crisis, where the 10-year interest rates were roughly 2.25% on average for 15 years. And the green line represents the 1990s, where interest rates were 6.25%, 6.5%. My point being, the current rate environment is definitely different than the last 15 years, where the Fed was in play, we had 0 interest rate policy in play. but rates are normalizing, and they're coming back up to levels that were very normal only 15 years ago, before the Fed intervened in terms of the bond market. Next slide. Not surprisingly, given the chart we just showed in the 15 years of very, very low interest rates, we believe that the opportunity set for fixed income is more attractive than it's been in quite some time. The gray bars here represent the 10-year range, and the blue diamond is basically the current rate of different bond opportunities. So US Treasuries on the far left, current rates around 4.5%, which is fairly attractive relative to where we've been over the last couple decade, let's call it. Municipals 5.8%, investment grade 5.3%. The point being, these are attractive rates of return for fixed income oriented investors who are looking for steady cash flow, and it's a competition for capital as well within the overall asset allocation mix. I'm going to pivot to the economy for just one or two slides. I referenced at the onset inflation. We peaked at 9.1%. If you look at the chart on the left, peaked at 9.1% in June of 2022, and we've come all the way back to 3.2% on a CPI basis. Most people believe that was the easy part. Getting from 3% to 2% is going to be much more difficult because prices are sticky and they tend not to come down as quickly as we hope. The thing to be mindful here, and we have an inflation data point coming out on Friday this week, is the last two data points were a little bit hotter than expected, in terms, meaning that the CPI print or the PCE print was a little bit higher than what the street was expecting. So this is a risk to our outlook for more constructive markets if inflation does pick up again. So we're keeping close tabs on this. The next slide, a very important slide. The gray line represents the unemployment rate going back to 1973, and the blue line represents wage growth. One of the reasons, in my estimation, that we've avoided a recession over the last couple of years is due to the very strong job market that we've experienced. Currently, the unemployment rate is hovering around 3.7%. And through it all, we've had a very, very tight labor market, which has kept people employed through a very, very high period of high inflation. Wages remain pretty robust at 4.8% relative to the 50-year average of about 4%. So you have wages that are running now above what inflation is running, and positive wage growth and very tight labor market. So we feel these are positive. But again, we're cautious about the outlook for inflation given the high wage growth. Next slide. In terms of the consumers were handed a lot of money during COVID, and they really carried the economy from 2020 through 2022, 2023. We believe there's a handoff that's happening right now. There's infrastructure spending related to the Jobs Act, the CHIPS Act, and in the Inflation Reduction Act, where we're starting to see money move into the economy to support infrastructure projects, grid hardening projects, a number of very, very impactful long-term projects that we believe will help carry the baton over the next couple of years, which should support industrial growth. We've seen a bottoming in manufacturing and a little bit of an improvement in some of the manufacturing indexes. So we feel like the discretionary spending, and this goes towards semiconductors and other things as well. So this hopefully will take the baton from the consumer, which has really carried the baton. Two quick slides. I did mention the election at the beginning. By and large, the stock market tends to do well in election years. So you can see in the top left chart here, during all presidential election cycles going back almost 75 years, the market's up around 7 or 8% on average over those 75 years. What's interesting, and if you look at the bottom and on the right, when there's an incumbent president running for re-election, markets tend to do even better. So this would be basically the current administration trying to stay in office, doing whatever they can to propel themselves, propel the economy, to get themselves reelected. So again, I think it bodes well for what could be a pretty reasonable market in 2024. 2025, depending on who is elected, we have a lot to think about in terms of next year. But getting through this year, I think, will be somewhat constructive. This chart basically says the same thing on the next page. Regardless of what your political affiliation is, Republican, Democrat, or divided, markets do okay in any sort of administration. Real GDP is 4% for Democrat, 2.8% for Republican, but markets do better under a purely Republican administration. So there's ebbs and flows. My point really is we try not to let politics run whether we're going to be fully invested or underinvested, because markets sometimes don't care who's in office. Coming home here, so I'm going to focus on two different trends that we've been focused on here, and we've been spending a lot of time with. AI. AI is sort of a buzzword. It's being talked about very, very broadly. NVIDIA has been sort of the darling of the AI infrastructure ecosystem. The first phase of this AI infrastructure development has come really on the heels of NVIDIA and its chips, its GPU chips, which, NVIDIA basically owns the AI market for GPU chips at this time, somewhere around 90 to 95% of the entire market. But there's a broader infrastructure ecosystem that is being built out. This is a chart that we've sourced from Goldman Sachs that gives you some context around different areas within the infrastructure ecosystem that we feel are ripe for sort of leaders of the next trend. Not that NVIDIA won't continue to do well, they will. But there'll be other parts within the semiconductor space, whether that's design, fabless designers, memory, manufacturing equipment that should do extraordinarily well. Data centers, AMT, Equinix, Digital Realty, servers and networking. So the point really is there is a lot to like about the infrastructure ecosystem. And we are trying and participating in almost all of these areas with individual names to participate. The second area that we've been spending a lot of time on is what's commonly referred to as the GLP-1 drugs. You're probably seeing commercials on TV for these all the time. Wegovy, Zepbound. These are Novo Nordisk's and Eli Lilly's diabetes and obesity drugs. This is a relatively new trend, although the stocks have been performing well ahead of a lot of this in terms of these are the number of prescriptions that have been issued in just a short period of time. The green line is Eli Lilly, which has quickly caught up to Novo Nordisk despite a one-year head start for Novo. The caption at the top really sums up sort of why we're constructive on Eli Lilly. Revenues are poised to grow 400%, 4x over the next 5 years, adding about $36 billion in revenue to Eli Lilly. So we think the opportunity set ahead of it is extraordinarily positive, and we feel like we're still in the very, very early innings of this GLP-1 rollout. And my last slide here is just some notes from our analyst who follows the stock. The real takeaway for me here is that obesity and diabetes are one sort of component of where these GLP drugs may be needed. So there's other illnesses like hypertension, chronic back pains, osteoarthritis, where some version of the GLP would be likely helpful in addressing some of those other comorbidities. So I'm going to stop there. I'm going to end with maybe just one comment, couple comments on what we're doing in our portfolios. Client portfolios are fully invested, both stocks and bonds. For the first time in 15 years, fixed income as an asset class looks fairly attractive to us. especially for clients seeking current income and predictable cash flows. And then finally, on the equity side, we're mindful of some elevated valuations. We feel they're somewhat justified. As I pointed out, we feel like earnings growth will come through. And, there's a lot of reasons to be positive, and there's an equal number of reasons to be conservative, which is why we're kind of maintaining our equal balance of stocks and bonds, our neutral stance to each asset class. So I went a little bit over, Jeff. I apologize. Kelly, I'm going to pass it off to you.
Thank you so much, Ryan. Great job. Good afternoon. This next topic is relatively complex and highly personal. And I only have a few minutes, so I'm going to keep this brief and allow time for my colleague Susan Matory-Baker from New Hampshire to talk about New Hampshire Trust. And our two topics really go hand in hand. So while this is going to be brief, it's a very complex topic. It's an important topic, and you may start to hear more about this throughout the year. So generally, and I'm just looking, slide 22. Generally it's recommended that if you have an estate plan, and hopefully you do, that you review your estate plan every 5 to 7 years, or when there's some sort of life event, marriage, divorce, birth of a child or grandchild, a death, or some other important event or milestone. It's usually a good opportunity, and your estate planning attorney would be grateful if you keep up to date and review your estate planning documents. So there is an upcoming event that's kind of looming in the distance, and while it seems like it's far ahead, we all know that the planning process can take time and can be relatively complex depending on the type of assets that are involved. And so we just kind of wanted to put this out there today so that it's top of mind and considered by all of you. So in 2024, the federal estate tax exemption is pretty high. Right now, it's about 13.6 for an individual and 27.2 for a married couple. In 2025, it'll be about the same. But then starting January 1st of 2026, the exemption will, at this point in time, and again, this is as of today, based on the current laws that we have, the estate tax exemption is going to be cut in half. And so it will be for an individual about 7 million, and for a married couple about 14 million. That, with inflation and whatnot, that could be highly impactful on a number of people. So it may be a good time to think about what's going on in your life, and perhaps look at your estate plan as it stands now, and consider talking to your estate planning attorney, seeing if there's any changes that are needed. One of the great things about Cambridge Trust Company is that we have a New Hampshire Trust Company. So that's a state chartered trust company. Cambridge Trust Company of New Hampshire can serve as a trustee in New Hampshire. And there may be, as you're out talking to your estate planning attorneys, it may be something to just consider that, we do have this New Hampshire entity. And my colleague, Susan Matory-Baker, the president of Cambridge Trust Company of New Hampshire, will talk about some of the New Hampshire trust advantages, which may be, appropriate for your situation. Susan.
Thanks very much, Kelly.
Thank you.
So we get very excited about estate planning here at Cambridge Trust. You have so many options available to you. I'm just going to talk about some of the advantages of a New Hampshire trust under New Hampshire trust laws. But you can see that Cambridge Trust Company of New Hampshire actually takes advantage of the full resources of Cambridge Trust Wealth Management. The client team is based in New Hampshire. It's audited by the New Hampshire Banking Commissioner, but your relationship manager, your trust administrator, they're all located in New Hampshire, which allows you to use New Hampshire trust laws. What are some of the advantages? On the next page, you'll see the list of just some of the advantages, and there's a variety. We'll talk briefly about those individual options that you have under New Hampshire law. First of all, directed trusts, and this seems to be the most popular because under New Hampshire law, the administration of a trust can be divided among more than one beneficiary or agent. So what happens is the trustee is only responsible for whatever requirement they are asked to oversee. So for instance, a trustee may have the responsibility to distribute assets among beneficiaries, but that trustee is not responsible to invest the funds. Under typical state laws, that trustee would be responsible for everything, and that's not the case under New Hampshire law. How about a spendthrift trust? Although a spendthrift trust provision can prohibit the beneficiary from transferring or pledging assets or assigning his or her interest, it sometimes doesn't protect the trust property. You really have to be careful with spendthrift trust provisions. Asset protection or wealth protection trusts, unique to New Hampshire. The person who establishes that wealth protection trust, although it does keep assets protected from creditors, in fact, the trust has to meet some pretty specific requirements. And if it does, the person who established that trust can actually benefit from it. Not always the case in other states. Dynasty trust, when we have a pretty significant trust, sometimes the donor wants that trust to go on forever, and it can in New Hampshire. For most states, the trust has to have an end date, either 21 years after a life in being, something like that, but in New Hampshire, it can go on forever. A purpose trust, for a non-charitable trust, in most cases, the trust has to have a named beneficiary, not in New Hampshire. A purpose trust can be for a stated purpose instead. For instance, this trust is to preserve the my lakefront estate. That's not a viable beneficiary, an ascertainable beneficiary, but under a purpose trust, you can actually name an estate. Modifiable and waivable duties. Almost any duty can be changed. Typically, we think that an irrevocable trust cannot be changed in New Hampshire. In fact, it can. For instance, duty to invest prudently. Typically, we see that in a trust. That can actually be changed or even eliminated so that maybe there's non-investment real estate or maybe a privately held business. Typically, a trustee would not hold those because they can't be diversified. But in New Hampshire, you can change that duty. Duty to inform. Under a typical trust in most states, you have to notify the beneficiary that there is a trust in existence for their benefit. In New Hampshire, you can really remove that requirement and have a silent trust, so there's no requirement to inform beneficiaries. So the trustee still has to act in good faith. You have to act in accordance with the terms of the trust, and especially comply with the intent of the donor. But you can make a lot of changes under New Hampshire law, and you can do it without court approval, which is also a unique advantage. New Hampshire also recognizes trust protectors and trust advisors. Those are not trustees, but they can inform the trustee and provide valuable information with regard to the beneficiaries. And that administrative efficiencies, that's where a trust can be changed through a non-judicial settlement agreement or decanting. So a non-judicial settlement agreement is just that. The beneficiaries agree to a change in the trust provisions. There is no court intervention. And decanting, if you think about wine decanting, you can actually transfer trust assets into a new trust. Again, there are specific limitations. You can't add new beneficiaries, but you do have quite a bit of latitude in decanting a trust. So you have a lot of options when you're planning your estate. Cambridge Trust can serve as the connection to New Hampshire if you are considering a New Hampshire trust under New Hampshire laws. We recommend and we work with a number of estate planning attorneys. So if you have an interest, we definitely would love for you to contact your estate planning attorney and investigate whether or not this is a viable option for you. So let us know how we can help. Now, the information that I'm sure most of you have been waiting to hear, please join me in welcoming our Chief Marketing Officer, Danielle Remus-Hackle.
Thanks so much, Susan. I am going to give everyone an update today in my capacity as the executive sponsor from Cambridge Trust of the merger with Eastern Bank. And it's important to note that Eastern Bank also has an executive sponsor, Don Westerman. We are working together to bring the merger in the right timing to integration. So a few good notes. As of February, both Cambridge Trust and Eastern Bank received shareholder approval for the merger. So that is great. Next up underway is regulatory approval, which has been winding its way through, and we are hopeful that that will be achieved over the summer so that we can bring the banks together, the banking conversion. And I'll highlight for you the conversion of the banks is happening in two parts. The first one is the conversion of the banking systems, and that will happen, we hope, in July or over the summer once we receive regulatory approval and we know when legal day one is and when conversion is. And the good news there is that right now Cambridge Trust and Eastern Bank are each on the same banking system. So even though we are separate banks, we operate on the same system, and those will come together smoothly. The wealth management conversion, the one for all of the clients here, will begin in September and wind its way through the end of the year. And we've done that deliberately at Cambridge Trust and Eastern Bank so that we're not overloading clients or colleagues with two conversions at once if they have a banking relationship and a wealth management relationship. So banking over the summer and wealth management in the fall. Good news also there, the system that Cambridge Trust uses for wealth management for your portal where you log in, called SEI, will remain the same for Cambridge Trust clients. So as Jeff mentioned, the platform that you're used to logging into and the Cambridge Trust brand, all of that will remain the same. And the most important part is that your relationship management team will remain the same at Cambridge Trust. So you will not experience changes in your relationship or on the platform. And at Eastern Bank, we are concentrating on making sure that the conversion for Eastern Bank clients who will move over to the Cambridge Trust platform, we're doing everything we can to make sure that that transition is seamless and smooth. Everything from training to branding to making sure that people know what to do day one. From a geography perspective, Eastern Bank has 110 locations, Cambridge Trust has 22. The vast majority of those branches will stay open. So if you use any of those combined 130 or so branches, they will still remain the same for you. Cambridge Trust will close 3 and Eastern Bank will close 8. And we're doing those only in places where you can see one branch from the other, and that would really be duplicative. So we'll close those, but the rest of the footprint will remain the same. And the staff that you know will remain the same. Anyone in the banking offices who currently have a job at Cambridge Trust will join the Eastern banking platform. So everybody that you normally work with will remain. Jeff and his team have 75 State Street. A lot of you clients go in there for meetings, and after July, the team will move into 125 High Street, which is where Eastern is housed. All of this you'll get in plenty of time so that you'll know what to do over the summer and beyond. I wanted to bring up on the screen now just some images of the Cambridge Trust brand and what that will look like. Thank you so much. So we will, in 2 phases, move into the Cambridge Trust logo combined with Eastern Bank. So on the left-hand side, you'll see once we merge, and we officially merge, you'll notice that Cambridge Trust will remain, the crimson color will remain, wealth management and private banking will remain, and underneath, now part of Eastern Bank. As we move into 2025, after some period of time, the underneath it will say a division of Eastern Bank, so that relationship is solidified and clear. On the next page, what you'll see is how the logos and brand will come together. Eastern Bank will keep its Join Us for Good, and Cambridge Trust will highlight our wealth management and private banking, and that we are a division of Eastern Bank and locked together. So that is what you can expect to see, and many of you will be familiar both with the Eastern Bank brand and the Cambridge Trust brand. So with that, I wanted to thank you, Michelle. Turn this back to you, Jeff, so that we can answer any questions that may come through from this group.
Great. Thank you, Danielle, and thank you to the rest of my colleagues for a wonderful presentation. There were a few questions that came across. So Ryan, I guess you've had the longest break, and you had the most questions. There was one on the Q&A that mentioned the Fab Four, and I think you already touched on this, but is there anything different about this market cycle compared to past? And I think you pretty much emphasized that, correct?
Yeah. So I'll start with the latter first. The cycle is very unique, and I think a lot of that has to do with sort of what we've been talking about in terms of the normalization of the market that's happening post-COVID. The world is sort of getting back to normal. Interest rates are normalizing. Consumer spending is normalizing. The excess savings that we had as a result of COVID is basically gone. And we're getting back to sort of a more normal environment. We had a discussion yesterday internally about, what should be working and what part of the market cycle are we in? And that's where we have a little bit less clarity. If this is early cycle, we should see small caps doing really well, and they're not. They're underperforming. So there's pockets of little things like that where things should be working, but they're not, and other things that are early cycle are working. So I guess all of this comes back to the fact that it's very difficult right now to really get our arms around what part of the business cycle we're in, what should be working, what shouldn't be working. So we continue to monitor that. In terms of the Fab Four, I'm actually quite happy to see a little bit of break apart in terms of the correlation of all these names. The 4 names that are doing particularly well at the top of the market justifiably should be. Tesla, we've always internally had a difficult time putting a valuation on Tesla. And that stock, I guess last year it was up a lot. This year it's down a lot. Apple is a name that we think is just an absolute great holding. It's a great core holding, but it's hard to justify valuation with the growth rate that they're seeing. They're seeing, 3%, 4% earnings growth, which is not very substantial, especially when you compare it to a Meta or an Amazon or NVIDIA. And I would say those first three names, which are part of that Fab Four, they all have ties to artificial intelligence, hyperscalers, the cloud, things that are right now are all working. So, I think it's, generally speaking, it's a healthy thing to see broader participation across the market and, more fundamental sort of reasonableness to what we're seeing in different stocks.
Great, thank you, Ryan. Susan, we had a question for you. Probably a simple answer, but if a grantor does not live in New Hampshire, can they still set up a New Hampshire trust?
Absolutely, but you do need a tie to New Hampshire, and that's where Cambridge Trust Company of New Hampshire comes in as trustee. We don't have to manage the assets. We do in some cases, and we can very well, as you heard Ryan's presentation. But you just have to have some connection to New Hampshire, and it cannot only be tax related.
Great, thank you. And Kelly, a follow-on question. Can Cambridge Trust remain like a successor trustee if someone moves out of the area?
Yes, absolutely. Yep. That happens for us from time to time.
Great. We did, it looks like there's a couple other, but there's one other question, Danielle. Looks like it's either for you or for me, but can you talk about your new office in Connecticut? Do you want me to
Yes.
handle that, or would you like to tackle it?
Sure, and then I see a couple in the chat,
Great.
Q&A that came through, so I'll read those while you talk about
It's
Connecticut.
all handled Connecticut. We've talked a lot about New Hampshire. We've talked a lot about Massachusetts. John Traynor is the president of Cambridge Trust in Connecticut. He has a team around him down there, Rob Marquardt, Mike Rispoli, and Grisel Rivera. And we just opened an office in Fairfield County in the town of Southport. So we're super excited about the team in Connecticut and the opportunity set. And I want to thank our clients down in that marketplace. We're also, wasn't a question, but I'll answer it. We're also making our way up into Portland, Maine. So Susan Mattori Baker just added Moya Elliott to her team up in Portland, and we have folks that live in southern Maine area on our portfolio management, relationship management team. So we're making our way up the coast from Portsmouth, New Hampshire, up into Portland, Maine. So we're excited about that as well. So go ahead, Danielle.
I see two questions related to the merger in the chat, so I'll answer them. One is checking accounts and names on checks. That is a wonderful question. If you have checks, you can continue to use them. Ultimately, the checking account will become Eastern, but if you have Cambridge Trust, you can continue to use, which is good. The online banking will convert. So the banking, these are good questions. The banking branches and platform will convert to Eastern. And the wealth management will stay with Cambridge Trust. So we will make sure that, first of all, that everybody's trained and knows what to expect. And second of all, that there is branding appropriate to each of those functions. But just to summarize, the banking functions will move over to Eastern, and the wealth management and portfolio management and relationship management and platform that you're used to for wealth will stay the same. Great. Underneath Jeff's leadership. And if anybody has questions, they should reach out to any one of the five of us on this screen.
Great. Thank you, Danielle. And I want to be sensitive to time, but Ryan, I think we have one more question for you. Your presentation was fairly constructive on the stock market. Anything that would make you change your perspective or your team's perspective?
Yeah, it's a great question. You know, I referenced earlier the expectation that the Fed will cut interest rates 3 times. And, you know, one thing we're monitoring is inflation. And if inflation does pick up and the Fed needs to increase rates higher, I think that would be a surprise that the market is not priced for. So that's something I think we need to be mindful of, you know, the inflation story and then how that relates to sort of the expectation for the Fed going forward. If you go back to the 1980s, you know, the double dip, they thought they had inflation solved and they didn't, and it came back higher, and that caused Volcker to raise rates and really choke the economy. So, you know, that's kind of the fear that's out there. And then just one last thing, which is really relevant this week, is an exogenous event that we really don't plan for. And in this case, the Baltimore Bridge accident is meaningful, and it's meaningful for transit, for travel, for ports. We've seen a lot of instances over the last 12 to 18 months, whether it was the Suez Canal or the Panama Canal, that caused supply chain dislocations and added length to timing of getting goods from point A to point B. That can be inflationary as well. So, you know, what might seem obviously a sort of tragic event, but that type of an event has a ripple effect. And now that all the goods that were supposed to go to Baltimore are now going to go to New York, New Jersey, or maybe Virginia, now those ports become backlogged, and it becomes sort of problematic on a grander scale. So, you know, you can't plan for those things, but I think you always have to be mindful and nimble of sort of what we didn't plan for and be aware of those things.
Great. Thank you very much to our panelists here today. Let me just close with a couple of things. Our 2 themes today were really 3, but 2 of them were about investments and our fiduciary capabilities. Those are differentiators for us in the marketplace. And I'll add 2 more. I'll add financial planning, which we'll pick up at a later webinar, and we'll also pick up on private banking. I wanted to let all of our Cambridge Trust Wealth Management clients know, and as well as welcoming our Eastern Bank Wealth Management partners and colleagues, that all of those things are going to be available to you. A strong investment management platform, fiduciary services coupling that, along with financial planning and private banking. And we feel like we're in a good position to serve you in the best manner possible. So thank you for joining us today, and look forward to serving you in the future.